Micron just crossed a $1 trillion market cap valuation on a forward PE of 8.6. Revenue grew 196% year-over-year. Most retail investors think they missed it. The data says the real move hasn't started. Net income went from $778 million in 2024 to $8.5 billion in 2025, an 11x increase in a single year. Gross margins sit at 58.4%. This is not a speculative growth story. These are mature, compounding numbers at an early cycle valuation. The stock moved 279% in 6 months, and is now trading near its 52-week high of $916.75. That kind of run typically signals a top. Here, it signals a transition. HBM demand is structural, not cyclical. Every NVIDIA AI accelerator requires high bandwidth memory. Only 3 companies on Earth manufacture it at scale. Micron is one of them. Hyperscalers are signing long-term supply agreements, not spot purchases. That changes the duration and predictability of the cycle in ways the market has not fully priced. Micron's HBM3E yields have improved faster than internal projections. The qualification process at hyperscalers typically takes 18 to 24 months. Micron is already qualified and shipping at volume. New entrants cannot replicate that position in a single product cycle. The revenue line for 2025 is projected at $37.4 billion, up from $25.1 billion in 2024. That is not a cyclical bounce. That is a structural re-rating in progress. The bear case starts with the analyst consensus, and it is not unreasonable. The average price target sits at $613.23, roughly 32% below where Micron trades right now. That is the entire analyst community, on average, telling you the stock has overshot. The trailing PE is 42.3. Memory semiconductors are a cyclical business. In 2022, Micron's stock dropped over 45% peak to trough as a memory glut hit margins. Investors who bought the prior peak waited over 2 years to recover. The 52-week low was $92.22. Anyone who bought the bottom is sitting on nearly a 10x return. At some point, those holders take profits. That selling pressure is real, and the current price does not discount it. The deeper structural risk deserves direct treatment. Samsung and SK Hynix control the same HBM market. If margins stay elevated, both have the manufacturing scale to respond, and history shows they will. Any meaningful supply response compresses margins faster than consensus models currently assume. Micron's 2001 downturn saw the stock lose over 80% of its value before recovering. A trailing PE of 42 on a business capable of near-zero earnings in a down cycle is a real and undiscounted exposure. Hyperscaler capex scrutiny adds a demand-side variable the current price does not appear to reflect. If AI infrastructure spending pauses, even temporarily, HBM pricing softens and the income statement reverts toward historical cyclical norms faster than the multiple implies. Position sizing for a range of outcomes, not a single scenario, is the correct frame. The bull case is built on comparables that are difficult to dismiss. AMD trades at a forward PE of 38.9 on 13.4% net margins. Micron, with 41.5% net margins and faster revenue growth, trades at roughly 1/4 of that multiple. By profitability alone, Micron deserves the higher valuation. It has the lower one. NVIDIA trades at 17x forward earnings with a 63% profit margin and is priced as permanent infrastructure. Memory is infrastructure. HBM3E is a required, designed-in component in every high-end AI training cluster, with qualification cycles that take years to displace. That re-rating has not fully reached Micron yet. The gap between where profitability would place it and where the market prices it today is where the return lives. The historical anchors reinforce this setup. In 2017, Micron's trailing multiple compressed sharply relative to forward earnings, the same configuration visible today. From that entry point, the stock gained over 200% in 18 months as DRAM pricing hit a supercycle peak. The 2012 to 2014 re-rating is the closest structural parallel, The stock traded below 10x forward earnings for 2 full years while supply tightened. When institutions accepted the structural case, it ran 300% in 18 months. In 2018, at roughly 4x forward earnings during the DRAM oversupply collapse, analysts called it a value trap. It then tripled over the following 24 months. In each of these prior cycles, the market priced in cyclical risk long after the income statement stopped justifying it. The same dynamic appears present now. The math supports a significantly higher implied value. At 15x forward earnings, a multiple still 60% below AMD's current level, the implied market cap exceeds $1.6 trillion, approximately 58% above today's price of $895. That is not a heroic assumption. It is a conservative re-rating toward what comparable profitability commands elsewhere in semiconductors. NVIDIA's path to its current valuation happened because the market accepted its category as infrastructure. That acceptance has not fully extended to memory. HBM is not a commodity. It is a designed-in component with switching costs embedded in hardware architecture. The re-rating, when it comes, will not announce itself in advance. Micron's capital expenditure commitment adds another layer to the bull case. The company has committed over $40 billion in US-based DRAM and HBM manufacturing capacity through 2030, supported in part by CHIPS Act funding. That investment locks in domestic supply relationships with US hyperscalers in ways that purely offshore manufacturers cannot easily replicate. The geopolitical dimension of this is not speculative. Defense and intelligence agency demand for domestically sourced advanced memory is accelerating independently of commercial AI demand. That second demand vector is not priced into any current model. The competitive moat in HBM is not just about yield or capacity. It is about the engineering relationship between memory manufacturer and chip designer. Micron engineers are embedded in NVIDIA and AMD design cycles earlier than any prior generation of memory partnership. Custom HBM3E configurations are co-designed rather than specified after the fact. That integration creates switching costs that do not appear on a balance sheet but are real and durable. The risk that breaks this thesis is a demand pause. If hyperscaler AI capex slows materially, the income statement can revert toward historical cyclical norms faster than the forward multiple implies. That is not a dismissible scenario. It is the central bear case, and it warrants sizing discipline rather than a concentrated bet on a single outcome. Are you sizing into Micron as a core AI infrastructure position, or treating it as a trade to manage actively? Drop your answer below. My position is clear. I am adding on any pullback toward $800. The 3 to 5 year case does not require a perfect entry. It requires conviction that HBM demand compounds alongside AI accelerator shipments. The multiple is not pricing that outcome. That gap is the trade.